Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There are textbooks in school where you look at it and go, God, I hope I can get a quality C. That would be Stephen Cicchetti, who was at Ohio State, a legend at Brandeis outside Boston, with work for the nation at the Bank of International Settlements, came out of the Salo Combine at Massachusetts Institute of Technology. Steve Cicchetti owns money in banking. He owns all the plumbing that you all learn and then you forget that has a lot to do with the Fed meeting here on Wednesday. Joining us, an expert on this, Amanda Lynam of Blackrock. You and I are like, we look at all this stuff and go, who's our expert on this? Why is short-term money so difficult? Why do we all worship Steve Cicchetti like that?
Good morning. Thank you for having me. I think the short-term rate is probably most in focus because it's the way that the Fed's policy transmits through the economy. When they are changing the reserve,
it's the screwdriver.
It's really the primary tool. And so when we talk about the Fed lowering rates, they're actually not changing the intermediate 10-year or the 30-year Treasury. They're changing the Fed funds rate, which is a much more short-term policy rate. What you are also alluding to is kind of the shift in the runoff of the balance sheet, which also has impacts on repo markets, short-term funding markets, and the availability of reserves. And so I'm actually less focused on that, I would say, for this upcoming meeting, because I think there are just so many points that we want to get from Chair Powell about 2026 and the path beyond and where the committee is.
Why do we care what Powell says about 2026 if he's not going to be here for opening day?
But I think his term will end in May, so he will be with us for a little bit longer.
So he'll be there when the Red Sox slip out of first place.
I think what I would like to hear from him, though, is kind of how the committee is entering 2026 in terms of the Hawks versus the Dovish split, and whether or not there is any sort of consensus around where neutral is. As you know, what we are most focused on is the depth and the drivers of the Fed rate cutting cycle, not the timing. And so I think that's really what we'll be listening for on Wednesday.
In terms of the credit markets, Amanda, great returns so far in 2025. It's been a good year. What's the 26 outlook for macro credit here? If
I had to sum it up, I would say we still have a generally constructive stance, but I think leaning even more into the idea that if you're allocating to credit, you should be allocating for income and all-in yield, not because there's room for spreads to move materially tighter, and actually not because we think long end or intermediate rates are going tighter. Actually, if you look at high yield spreads, they're back at 264. That's actually not that far. It's a couple basis points from the local tights. So we are really, in some ways, priced for perfection in credit.
You too, in your jargon.
Yeah.
Sure. Basically, we're priced for perfection.
Indeed. There's very little room for spreads to move materially tighter. I would say, though, I would be remiss if I didn't say this, at the same time that spreads are tight, and we acknowledge that, the bar for credit spreads to move wider on a sustained basis is also very high.
Bloomberg surveillance across the nation. Good morning on a Monday. Look, Paul, look out the window here.
Dark.
It's dark. What is that about?
Zero dark 30.
Wednesday light savings time happened. We say good morning across the nation on YouTube. Subscribe to Bloomberg Podcast. Anastasia, Amoroso with us here in a moment on 92.9 FM Boston, 99.1 FM Washington, here in the tri-state area. Amanda Lynam of Blackrock with Paul Sweeney.
Amanda, talk to us about credit quality out there. We haven't really heard any problems out there. Are you concerned that could be an issue for 2026?
What we are seeing are idiosyncratic instances of defaults, I would say underperformance of certain cohorts of credit, triple C's in the leverage loan area, smaller issuers in private credit, for example. So we are seeing, I would say, dispersion, but it's stopping well short of market disruption. And I think that's a trend that will continue into 2026. In general, I think one of the most interesting dynamics has actually been in the investment grade landscape, where you've seen higher rated companies kind of methodically add debt to their capital structures. That's a trend that we think will continue into 2026. And then I think in general, one of our views has been that the peak in credit defaults in the leveraged finance universe is likely behind us at this point. They peaked in November of 2024 in the leveraged loan market, and we feel very confident that peak is behind us.
When you do a, quote, deep dive analysis of private credit fundamentals, which restaurant do you go to in Midtown?
So that is actually an extensive analysis of thousands of companies that we can track through third-party data sources across the U.S. and Europe using a variety of third-party tools. So we're doing that in an industry-wide analysis. The takeaway in our view,
please,
credit fundamentals at a high level, so think interest coverage, covenant defaults, are actually improving. Under the surface, though, there's wide dispersion in EBITDA growth, for example, across company sizes, company sectors. Again, fits with that point that Paul alluded to, dispersion but not disruption. But really, in general, credit in private credit is mirroring a lot of the same themes that we see in liquid credit. Under the surface, more differentiation, but in aggregate, solid fundamentals.
Is it being priced? Paul, help me here. You're better at it. Is it being priced fairly? Is that the right language?
Yeah.
Is it like... this stuff is like not liquid. Is it? Do you know the price of it when you do a deep dive?
We can track that actually in spread levels for new private credit deals and spread levels for new liquid credit deals. So kind of an apples to apples comparison. What you see is that as the risk on tone in the liquid credit market has been strong, not dissimilar to equities, spreads for new private credit loans have also tightened. So the markets are moving in tandem. It's very consistent with our view that there's almost a financing continuum across these asset classes where they're not siloed like they used to be several years ago. Actually, private credit can service and is servicing borrowers that are large enough to access in the public markets. So, I mean,
BlackRock, you guys do everything. You're everywhere. So do portfolio managers come to you and say, educate me on the private credit market, I want to maybe increase my exposure? Is that how the conversation goes?
I mean, I would say our information flow across the firm goes in both directions. And I think that's probably a really strong competitive advantage. But yes, I would say, and this goes to our clients as well. Several years ago, when we were having conversations with investors, maybe it was a different person allocating to private credit versus liquid credit. Mm-hmm. Now there's actually more commonalities. Okay. It might be the same person. And I think that makes sense because the relative value discussion is not happening in a silo in these markets. That liquid credit is informing private credit and vice versa, never mind equities, for example, and rates.
Are there certain sectors here just across the fixed income space, the credit space, that are, I don't know, screening well for you guys these days?
I would say we continue to like financials. This was actually something that came up at the Bloomberg Intelligence conference last week.
JP Morgan reports earnings, the next day they come to the bond market.
Sure.
And they call you guys.
So financials are great from the perspective of we actually like the sector from tailwinds of M&A, capital markets activity, deregulation, but also financials offer you an ability to move down in capital structure in an issuer that you like, right? So maybe you're in the subordinated debt versus the senior, and that's actually a way to pick up additional return in an issuer that you feel comfortable with. I would also say that heading into 2026, we're kind of watching for a reacceleration in the middle income consumer. So cyclicals in some areas could be attractive.
A nice brief here for Global Wall Street and fixed income. Amanda Lynam with us with BlackRock, Anastasia Amoroso on the equity markets. We'll do that in a bit. All sorts of good guests coming up with good conversation. Right now we're efforting Geetha Ranganathan on the news flow over the weekend on Netflix. Lucas Shaw with that extraordinary article of conversations.
That was really good yesterday.
At the White House. So we're hoping to get Geetha on here at some point. How do you look at it? It's off your remit, but I'm going there. And don't give me this compliance malarkey. No one's listening this morning. The bottom line is all these big tech companies like Netflix, like, you know, the names don't matter. They can issue billions of debt. What's the so what of that?
A couple of things. One, as a credit investor, if a company is highly rated, it's not a foregone conclusion that they will stay at that rating. So I think that's kind of first and foremost. It reminds me when I covered healthcare many years ago, a lot of those companies were AA, AAA rated. They waited for strategic M&A deals, but they used that balance sheet flexibility, added debt to their capital structure, took a couple of notches of downgrade, but we're still in investment grade territory. The other key thing that investors watch on M&A financings, if it is funded with cash or debt, oftentimes there's a period of increased leverage followed by deleveraging from the company. So listening to what the management team says about what is their plan to get back to the target leverage over X period of time, that is something that investors closely watch. So say a company is temporarily above their target leverage, but has a plan to get down to their target within 12 to 24 months. That will be something that investors will watch closely. So there are a lot of implications for capital structure, for rating, for credit quality. But in general, most of these companies are very committed to staying investment grade. It's just the degree of how highly rated they are. And I think the takeaway from even the post-pandemic period is CFOs and treasurers don't need to be AA or AAA rated to have ample access to the capital markets.
How about new issuance? What's the expectation for 2026?
I think there's scope for a re-acceleration. I would say one of the views that we've had for a while is that the strategic M&A rebound that we've definitely seen over the past few months is poised to extend into 2026. CEO confidence is a big implication of that. I think there's a lot of unfinished business from the pandemic in terms of diversification that companies will want to achieve. Some of that will be funded, as it has been, with cash and debt historically. So that will result in issuance in the capital markets. And then also the maturity walls in 2028 and 2029 in the high yield market are steep. I think it's reasonable to assume that companies, as they have been, will pre-fund years in advance.
I don't look at the yield on money markets because of the triple leveraged all cash flow. I'm, net clean with a field goal out at 9-10%. But all of a sudden, I noticed this weekend, money market funds have come in from what, Paul, a glorious 5%, steady 4%. How is the flow dynamics of what has BlackRock seen on money market funds nudging under 4%? There's
been an expectation that some of that capital will flow into, say, credit and equity markets, but
has it?
It hasn't really to the extent that many anticipated. I think part of that might be while those numbers in absolute terms are large, as a proportion of the overall invested landscape, proportionately, they're not that out of line because, as we know, equity values and fixed income have increased as well. So I think it would be a bonus if that money flew into the markets. But I would say the demand backdrop outside of that is very robust, and we're not relying on that for a constructive view in risk assets.
And on the folks, there's a screen, BTMM screen, which is just magnificent. Somebody taught it. I think Gura taught me this screen years ago. The 3-month T-bill, Paul, 3.63%.
Yeah.
Did I know that? I mean, it's sort of crept up on us.
I mean, I know seasoned investors, all they do is roll T-bills today. Yeah. That's what they do. And they go skiing, they play golf. That's all they do is roll T-bills.
Well, that's the way Amanda Lynam rolls.
I don't know. And they say that's a living.
Okay. What do you tell equity market people? I'm a big believer that the bond market leads in analysis and zeitgeist, if you will, the equity market. What would you say to Anastasia Amoroso right now about the bond market that affects equities?
I would say two things. One, we are looking to the equity market for the earnings trajectory, which I think is very much informing the resilient tone that we see in credit. Oftentimes, equity investors will be thinking about where can a company access capital in the corporate credit market. And I would say right now, if I had to relay one message, it's that capital markets are wide open and robust.
Absolutely. Thank you.
Thank you.
Yeah. Thank you for coming, and thank you for all your work for us this year.
Thanks so much.
I hope we see you before the end of the year. Amanda Lynam, she is with Blackrock, just extraordinary with all the different nuances of fixed income. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We are advantaged. And again, folks, I can't say enough. If you have conversations with quality people, the news flow always fits in. Geetha Ranganathan, her people, they said, she's not coming on unless there's headlines. In real time, we have paramount headlines coming across the Bloomberg Professional Service. Geetha, let's just start with the sum total. Are you surprised at the rapidity of the Ellison response to what we saw with Netflix and Warner Brothers Discovery?
Yeah, not surprised at all, Tom. I mean, we knew they were not going to go away easily. There was so much drama last week, even as we knew that Netflix was kind of closing in on the Warner Brothers deal. But just from, first take, so basically even last week, we know that as Netflix kind of made its offer at just a little bit shy of $28 per share for the studio, Paramount had actually made the offer for a $30 cash bid for all of Warner Brothers Discovery. So the thing is, when you kind of compare the two offers here, the Netflix offer is still superior because it's only for part of the company, the remaining part of the company, which is the TV networks business, we value it at about $4 a share. So you put the value of the total Warner Brothers Discovery assets, the entire portfolio, at $32. So right off the bat, slightly lower than what Netflix is offering.
Right.
Of course, I think the way that Paramount Skydance would frame this is there is a lot less regulatory risk and there is much more certainty that this deal actually goes through.
Paul Sweeney with Geetha Ranganathan. Paul, I'm just going to say within the 45 headlines, the enterprise value numbers are 80-ish billion versus 108 billion with this new offer, up 20 billion-ish. See how I nailed that?
Exactly.
That's why they asked me to leave the room. Continue, Paul, with Geetha Ranganathan.
Keith, as you talk to institutional investors out there, is there a preference for Warner Brothers Discovery shareholders? Which deal would they prefer here? I mean, this one, the good news about this one is 100% cash versus the Netflix, which is mostly cash, but there is an equity component.
Yeah, I don't know if that makes too much of a difference, Paul, because we're talking about Netflix stock, which is really equivalent to cash, or maybe even better. I mean, this is a company that was valued right before this deal went through at about 30 times forward EBITDA. So again, a lot of value in the Netflix stock. There's fantastic earnings power. There's fantastic free cash flow potential. So I think that the deals are pretty comparable. As I was just mentioning to Tom, just from the first look of the deals itself, the Netflix offer is actually superior because you do have a $4 value on the TV networks. And here the implied value with Paramount would be $2, which would obviously be lower.
We say good morning to Los Angeles and, of course, to Michael Milken as well. Quote, Junk Bond King, Drexel, Burnham, Lambert, 1980s. What I see here, Paul, is the word hostile. And the answer is there's new tensions in the debate as well. Is it going to be easy, Paul, to go out there for either party in this battle and get debt and equity deals done?
No, I think the capital part of this is going to be, that's the easiest part. There's lots of capital out there. So I think either deal can get done very easily in this marketplace. So, Geetha, one of the issues Tom brings up here is in the initial Paramount Skydance, they were talking about maybe getting some equity capital from Mideast partners. That made some people uncomfortable. And I don't see the Mideast partners in this transaction. This is basically saying equity to be backstopped by Ellison Foundling and Redbird Capital. And folks, Redbird Capital is a investment bank that focuses on the media and entertainment industry. They're well known in those circles. So it looks like this is the Ellison standing up and saying, we're going to fund this whole thing.
Yeah, absolutely. And the problem with that initial reporting, which suggested that about 20 or 21 billion was going to come from, the Saudi sovereign wealth funds, is the problem that once you have a foreign investor involved, there's a whole different regulatory angle to that. And so then this is basically, Paramount saying, hey, look, we're going to get this deal on fast track. You should be really choosing us over Netflix because that is fraught with so much of antitrust and regulatory risk.
I mean, just Redbird Capital, folks. And when I went up to Fenway Park a couple of years ago, I mean, the turnaround for the Red Sox, that happened when I went up there and did the CFO story. Redbird Capital is involved in all sorts of sports. They have Aaron Judge on the cover of their website, Jerry Cardinale, and importantly, John Thornton, who has a heritage here with Robert Klein. I mean, This is not an upstart firm. Our listeners and viewers, folks, may not know Redbird Capital. But, Paul, can I assume they're players in this?
Yeah,
I mean, they're a familiar name.
They're definitely players. And then they've also got the debt capital is going to be led by some big players there, Bank of America and Citi and Apollo Group. So Paramount's got all the capital lined up there.
Oh, yeah, look at that.
Yep. So like all the players.
Is there a bank that's not involved in this transaction?
Everybody's going to get paid here. And Michael Klein, who used to run Citi's investment banking, his firm is also advising. So everybody's involved here. So is this just simply, Geetha, going to be whoever comes in with the higher number wins? Is this how this might play out?
I think so, Paul. And I think, what's going to be interesting is if Netflix is now forced to increase its offer, right? I don't know if the $28 is going to cut it anymore. Do they need to take it up to $30 a share or even higher? That is the question. Yeah. And in all this, the big winner, all this drama, the big winner continues to be David Zaslav.
Geetha, I look at this and I think of Lucas Shaw's magisterial effort this weekend. Geetha, did you help him with that? Did you deserve a co-write on that story?
I did not, unfortunately.
The photographs, and for people like Paul and you are steeped in this. For all of you across the nation, I'm like you. It's like, how many times have I seen Casablanca? And the photographs, Geetha, of the Paramount studio and the gauze of the morning sunrise with the hills that you used to be able to not see. Now with the better pollution, you can see the San Gabriel Mountains, the Hollywood Hills. Who do all those people want to win this hostile battle?
So really, if you look at it from a Hollywood perspective, Tom, I think they would actually prefer Paramount. And a big reason is because Paramount is big in terms of movie, in terms of TV content. I mean, they want to, bolster the studio operations. We know that they're not going to cut back on, theatrical releases. So in many ways, I mean, with Paramount, you get more of a known devil, if you will. With Netflix, there's just too many unknowns. I mean, yes, they're saying all the right things now just to appease regulators, but who knows what they'll do down the road.
Geetha, Paramount obviously owns the Paramount studio. Warner Brothers owns Warner's studio. Is that a regulatory risk, putting those two together? Because that would leave just Universal and maybe Sony.
Yeah. So I don't think so. So actually, if you put the two studios together, you do get about a 25 to 30% domestic box office share. The trigger point, as pointed out by Jennifer Rhee, our antitrust analyst, is usually something greater than 35%. So they should still be okay from an antitrust standpoint.
Geetha Ranganathan with us. We welcome all of you across the nation. Good morning around the world as well. All the different ways. I'm podcast on Spotify, Sirius XM. Thank you for listening on YouTube. Subscribe to Bloomberg Podcast. Paul, I'm learning every step of the way. I thought the Paramount logo was the Matterhorn because I was there as a kid, blah, blah, blah. No, 1914, the founder of Paramount, William Hodgkinson, sketched on a cocktail napkin Lamont Peak in Utah. It's a mountain in Utah.
Okay.
I'm learning every day here as we go. Paul Sweeney with Geetha Ranganathan on this new news on Netflix and Warner Brothers.
Geetha, what do you think the response will be from Warner Brothers Discovery here? What are the next steps, I guess?
So they already actually rebuffed this. So in the, just as the deal was closing with Netflix on Thursday evening last week, Paramount actually made this last-ditch effort, putting across this $30 all-cash bid. None of the details were known, but Warner Brothers actually rejected that. So I'm not necessarily sure that, this is going to work with the board. Of course, they're going hostile here. They're taking this directly to shareholders. Again, the number itself is not super enticing. I think they're going to have to do slightly better. But then again, who knows?
So, I mean, again, I guess Comcast was the other bidder. Do we have any reason to believe they will come in and play in this game?
I highly doubt it, Paul. I don't think they want to get involved in another very, very expensive bidding war. We've seen this movie before with Comcast. Yep. They went into this when Disney Fox, when the whole Disney Fox drama was going on. They overpaid for Sky. They paid a 15x multiple when they should have probably paid about 7x, and they've been reeling from all kinds of pressure ever since. And if you just look at the business composition for Comcast, 85% of EBITDA comes from their cable broadband business. So that's really what they should be focusing on. So I think even if they don't bid, I don't think it's such a big existential question for Comcast right now.
What are you going to look at today, Geetha? I mean, away from all the numbers and the excitement of a bid and all that, what's a grizzled pro like you going to look at on the Excel spreadsheet?
The synergies. So, when you kind of think about Netflix actually laid out $2 to $3 billion in synergies, and that's with only part of the operation. That's only with the studio and streaming business, and really all of those synergies are just going to come from the streaming business. Because you have HBO Max, you have Netflix. You don't want to run two separate services necessarily, so it's combining the tech stacks. In the case of Paramount, there's a whole lot more of synergies that can be extracted. You have two separate studios. You have two separate or many streaming platforms. You have two different TV networks divisions. So when you kind of look at the savings potential there, obviously it's huge. It just means that Paramount can actually go much higher in terms of a bid.
And while you're on air with us, Geetha, published moments ago, Paul, from that 2 to 3 billion synergy, 6 billion plus synergy.
Yep.
I'm going to call that a double. a double synergy
Sure.
if Paramount takes over.
Yep.
Isn't synergy French for firing?
I think so. So if I'm a set designer at Warner Brothers, I look across the street and I see a set designer at Paramount. I'm like, well, we're not going to have two of them.
Geetha, how bad will the carnage be in Hollywood off this, looking at these synergies?
It'll be bad. It will be very bad. I mean, we're already seeing that from Paramount Skydance, and Skydance is so much of a smaller studio operation than Paramount. So this is obviously going to be awful in terms of job losses.
Generous of you to be with us with these breaking headlines. Geetha Ranganathan owning the high ground on. Is it okay for me to say crazy Hollywood?
Sure,
It's
absolutely,
nuts.
yeah. Well, there's just a few chairs left in Hollywood in terms of studios, and this one's trading, so you better put your best foot forward.
Am I surprised as an amateur here that Disney is absolutely silent? Like, silence.
And at that, I think that's a great strategy. Let these people do their craziness, and we're just going to sit here and make movies and TV shows and, theme parks and cruise ships and all that kind of stuff.
Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What a joy to go down and stand in between two dinosaurs at the Houston Dinosaur Museum. Like they were like Jurassic Park, scary, like real, not like in New York City, like really like, oh, they're moving, aren't they? And meet with the CFA Society of Houston. It was a high point. Joining us here, the queen of shopping around the River Oaks district, Victoria Fernandez. Houston is lovely.
It is, and I'm glad you were able to experience that. But I have to say, I was afraid you were going to call me a dinosaur at first when you started that intro, but I'm glad that wasn't it.
But the vitality of Houston, I was sort of blown away. It's the stereotype of oil. It's way more than that
It
right
is
now.
so much more than that. 70s, 80s, yes, you can say it was an oil and gas economy. Exactly, which we love Landman. But yeah, this city has changed dramatically. It's a very diverse city, both in terms of population and in terms of the economy.
So, Victoria, 2025, a little bit in the rearview mirror here. S&P up 15%, the NASDAQ up 20%. Fixed income, some very high single-digit returns. Let's lay the groundwork for 2026. What's the conversation you're having with your clients?
Yeah, so we're telling them to bring their expectations down a little bit for 2026. They've had 2 years of really strong growth in the equity markets and in the fixed income markets, as you've talked about as well. But I think we're going to see that pull back a little bit. Now, we've had a little bit of consolidation in the markets already at the end of this year. I think as we go into next year, first quarter will be pretty strong. You've got a lot of stimulus coming in the first quarter of the year. But then I think that will start to fade. And the question is, can earnings survive? And if so, then I think you have a decent year. But if we start to struggle on those earnings, then I think we could see some struggles.
And on the earnings front, boy, second quarter, very good. Third quarter, really good. What is your earnings outlook for next year?
Yeah, look, third quarter, I mean, we were double expectations on EPS growth, right? And revenue growth close to 7%. Again, we look out and we go, but if the consumer is starting to slow, the consumer doesn't have to fall off a cliff, but if the consumer is slowing, and we saw real spending come out at being flat last week, then you're looking at less spending, you're looking at revenues coming down, you're looking at margin compressions. All of these things tells us that we should see earnings start to pull back a little bit next year.
I mean, we had tariffs. I'm going to say it's kind of been almost a non-event after you got after that initial shock. Haven't necessarily seen it in the numbers or in the economic data. I'm not sure.
And I wonder, Paul, if you just jinxed us, right? By saying that.
Very possible.
I do think we have the Supreme Court decision coming along on IEEPA, right? And that could bring some more volatility. But I think in the long run, there's not going to be an issue around refunds. And it's going to be more of how the administration puts them into play than if they do.
Your magic of saying, hey, you're scared, you've got to participate in the markets. It's really been noted. This is Crossmark Global Investments. This is Victoria Fernandez, of course, and always Bob Dahl. Okay, great. But what's changed is the money market fund is not 4.x% anymore.
Correct.
What is the behavioral change in Crossmark clients from a 3.6% money market fund?
Yeah, I think clients before were okay letting cash sit around. They didn't feel that opportunity cost so much because they were earning higher rates in that money market. Now, however, we're saying, but look, you've just seen the 10-year go up 14 basis points, all right, on the treasuries. You're seeing a steepening of the yield curve. There's some opportunities because there's rotation, Tom, that we're seeing. It's not just healthcare and utilities and energy like we've talked about. We're seeing a rotation on the internals and transportation, global autos, global materials. You're even seeing it in some of the home builders. So if we're starting to see some opportunities there that the internal trends are shifting, there's where you want to go ahead and put some money to work.
Victoria Fernandez here on the greater equity market. What inning of Houston, you're driving over to the hotel and you go by the Houston Astros stadium.
Or if you're driving, you're in traffic is what you're doing.
Yeah, that's what we're doing. In a Houston Astros game, what inning are we in this great bull market?
I think you might be doing that 7th inning stretch right about now. You're singing the song, you're getting your bag of peanuts for the end of the game. I think we're getting close to that just because the stretch that we've seen in valuations, again, we might be hitting that peak earnings expectation and coming in, even though there's stimulus coming next year. Like we said, there are quite a few headwinds still, labor market deteriorating, manufacturing weakness, all of these things that we continue to watch. So I think you could be getting towards the end.
In the 7th inning stretch, Paul, your official beer of the Houston Astros, a Crawford Bock.
Really?
Yes.
I did not know this.
Did not know that.
That's a local beverage?
It is.
Wow, that sounds pretty good.
Every time she comes, it's a font of wisdom.
We'll head down to it.
And you have to sing Deep in the Heart of Texas for 7th inning stretch. That's,
Is that right?
There you go, with your Crawford.
What are we doing in the bond market here? Again, I got some very nice returns in 2025. Particularly in the credit markets with leverage loans and high yield, is that still the play here?
Spreads had widened out a little bit. There was a lot of concern, and you have people talking about private credit and is that going to leak into investment grade? Now, you look year to date, high yield has widened out pretty significantly, especially triple C's, but investment grade has not. It widened and it's come back in. So I do think you need to be very selective as to when you hop in the credit market because you want to watch those spreads right now. You don't want to pay too much for those, but you've got a steepening yield curve. 20s to 30s is steepening, and I think the long end of the curve is going to continue to go higher. Look at what Japan is doing, fiscal supply coming in. I don't think inflation's coming back to 2% anytime soon.
Right.
So I think that steepening gives you a chance to go out a little bit longer on the curve.
Okay, I'm sorry, but there's some things in America that maintain. You think of all the upset, Paul, over the year. It's a good and wonderful thing that Texas A&M will play in the Goodyear Cotton Bowl Classic. That's from my childhood as well. How exciting. I mean, this is great. Texas A&M, the Fighting Texas Aggies, take on the Ohio State. Is the Indiana Watches. Are you going to go to the game?
I will not be at the game, but I will be watching, and it's going to be a tough one. I mean, against Ohio State, it's going to be tough, but we're going to give it all we got.
Go the Aggies.
Yeah.
And we know some Aggies here in the building.
Do you?
Just met, sure.
Just met.
And I know people are upset about some of the group of 5 making it, but my daughter is in her first year of law school at Tulane.
Oh, okay.
She went to NYU here, and she said, who knew Tulane would be my football school, right? That I ended up getting to go to. So, interesting.
Very cool.
Exactly.
Yeah, I noticed that. The Tulane, it's sort of like Duke. It's like, oh, they play football.
Yeah.
Exactly.
Okay.
It's a great school.
Thank you to Houston for the hospitality down there. It was really, really.
We're glad you enjoyed it. Come back anytime.
Trust me, after going to not River Oaks or something. What's the little shopping mall there? Like little streets and little stores.
There's Rice Village. There's Highland.
Many.
Yes, there's Highland Village. There's a few of them.
I don't know which village we were in, but my wallet was light. And Victoria Fernandez, thank you so much with Crossmark Global Investments. Greatly appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Terror of the University of New Mexico with Partners Group, Anastasia Amoroso. You nailed this 3 years ago. Do you have the same conviction on equities now that you did 3 years ago?
I do. Look, it's a bit of a different feeling going to 2026 because of where valuations are. But yes, we still do have the convictions that new highs, higher highs are still ahead. And, the reason for that is this combination of policy support, I would say, around the world. But in the U.S., it is about the rate cuts. It is about the tax cuts. It is about the midterm elections that will likely shore up some additional support. So yes, that should support the market.
Is it easy as Atlanta GDP now is 4%? Now it's 3.53% real GDP growth estimate right now. Does that just bring you right over to double-digit earnings growth?
I mean, yes, it's been supportive of earnings growth. I think AI has also been supportive of earnings growth and the adoption. Well, because it does, in some cases, drive productivity. Some companies are citing that 20 or 30% is the increases in productivity that they're seeing. I will tell you, across our portfolio companies, embedding artificial intelligence is a big focus as well.
Right.
And so we're looking for something like $170 million in EBITDA uplift across portcos because of that.
Did the Jets get uplift because they use AI?
I don't think so. No, I don't think so.
Boy, that was ugly.
That was ugly. It seems like central banks around the world, for the most part, are in an accommodative mood here. And how does that figure into your 26 outlook?
That's right. I mean, the U.S. certainly accommodative, expecting a rate cut this Wednesday. And it is priced into the yield curve, which, some may push back and say it's already baked in. But I would say it's all about the impact on the economy, and that is to be felt in 2026. So when you apply 75 basis points to over $11 trillion of floating rate liabilities, that's a lot of resets lower that are still to come. And then also on the flip side, Paul, you've got fixed rate maturities that are coming due, and those will be refied at a lower rate as well. So that's a lot of cash back to the corporations, in some cases, cash back to the real estate operators and the consumers. So that certainly is accommodative for the U.S. I will say in Europe, consensus is sort of assuming that the ECB is done and will stay at 2%. We think one or two more rate cuts is possible in 2026 over in Europe. That should also be supportive.
So you're a Partners Group now, and I just did my Google search. I went through your website. Private equity, global private equity provider. What are the folks at Partners Group thinking about? Is this 26 going to be a good year to put capital to work?
Yes, we absolutely think 2026 is going to be a good year. 2025 actually turned out to be a good year.
Right. Yep.
So I will say industry-wide transaction activity is looking to be up 35% year over year, which is quite significant. In Europe, maybe you wouldn't guess it, but we're actually looking for the best year since 2021, even slightly surpassing that. So activity is back. And Paul, I would say the reason for that is the buyers and sellers who kind of been far apart are coming a lot closer together. I think part of it has to do with those rates falling because financing conditions are more accommodative. As Amanda said, capital markets are wide open, and that means you can finance the transaction, you can get better deal economics, and all things equal, that kind of supports the interest in making that transaction happen.
All right, so your firm is Swiss-based. The name of the city is Zug.
Zug, Switzerland.
What is Zug? I've never been to Zug.
It is a city outside of Zurich. It's about 40 minute drive from there. It's a wonderful place. You should visit.
Looks beautiful.
But that is our Swiss headquarters. Our America's headquarters are in Denver, and of course, a large presence here in New York.
You have a spectacular. The folks. Zug. We protect the copyright of our guests. Get from Partners Group Anastasia's Miracle newsletter because it's got her report has all sorts of sophistication. Your AI chart is complex.
Yeah.
And it's a remarkable growth pattern to 27. What's your conviction, your certitude that AI will develop commercial opportunity?
It's high, Tom. It's high.
Why?
So first of all, a lot of people talk about AI bubbles, but let's describe what is what do we even mean by AI bubble? Is shortcut to productivity, is that in a bubble? Do we want to use less ChatGPT? Do we want to use less Perplexity, Anthropic, and Gemini? And do we want to roll back? No, it's quite the opposite. I think the genie's out of the bottle. The productivity is there, and everybody wants to embed it.
I used Perplexity this weekend, Paul. I
know, you're all over it.
I'm all over it. I type in, if I cut down a Christmas tree in Central Park, what time is the best time of day?
Do it, right.
It's kind of question.
What's the answer?
The answer is 2 a.m. and you'll enjoy it at Precinct 57.
Exactly.
Don't do that, folks at home. That was a joke. But Anastasia, how does Johnson & Johnson or any other given company, the identifiable path to 2027, how does AI generate better margin?
Right. So first of all, it is about productivity. It is about driving efficiencies. And as I mentioned, Tom, across our portfolio companies, about $170 million in EBITDA uplift, which translates to about $2.5 billion in enterprise value. How do you do that? Take, for example, an industrial tech operation or a complex supply chain management or like an enterprise resource system. Think about processes that require a lot of data inputs that maybe previously have been manual, not connected, but with embedding of AI tools, you can connect all those different disparate sources. So that's, I think, how a lot of companies are driving those initial value creation with AI. Longer term, it is also about the revenue uplift. And we're seeing some preliminary, I would say, signs of that. One of the surveys that I've seen from McKinsey is that most companies are realizing less than 5% in terms of revenue uplift. Some have more than 10, but very few. But I think that's on the roadmap, Tom. That might be not the first wave, not the second one, but the third one. But for now, it's about cost cutting. It's about getting more out of the same amount of resources.
Paul, she's underselling it. Zug is looking out over the lake. It's absolutely gorgeous.
Those offices are nice,
popping.
Tom. But
I'll be later there this week. And
these
yes,
Denver
it's
headquarters
nice.
might be even better. It's right between Denver and Boulder. You're familiar with that?
You should
the
absolutely
offices in Denver
come out.
look awesome here. God, how come I don't know about you guys?
You should absolutely come out.
I don't know
We've
you could fill
hosted
an
clients in
ocean.
our Denver headquarters earlier this year.
Yeah, on my way to
seem
Aspen
enjoy it.
this February. Talk to us about, just real quick, 30 seconds. Earnings seem really strong out there. Are they enough to support this market?
Yes. As Tom mentioned, as long as the economy is on solid footing and there are also levers that companies are pulling to offset the tariffs, unfortunately, that does resolve itself in weaker labor market. But as far as corporate America goes, we're expecting 9 or 10% earnings growth next year. And all things equal, that should translate to about 7,500 or so on the S&P 500.
Nice. Did you do an equity briefing at the Park Hotel in Zug? Wicked fancy, Paul.
Yeah. We can set up shop there.
They have a fondue hut where it's a place to glow.
Okay.
Have you been in a fondue hut at the Park Hotel?
I've not yet been. I've been to the Park Hotel. I've not yet been to the fondue hut. I may check it out this week.
She's going to Zug tonight.
She's
flying over tonight.
It says road trip to me. Anastasia Amoroso,
Please come
Partners
visit
Group
us.
of Zug, Switzerland. Thank you so much for inviting us to the fondue hut, Zug, Switzerland.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.